Our guest says software stocks are the most insulated sector from the current trade tensions and potential supply chain chaos. Let's bring in Nick Mersch, portfolio manager at Purpose Investments. Great to see you.
Great to see you as well.
I guess the great thing about software stocks is you're not shipping physical merchandise. I mean, that's the first advantage in the tariff war.
Yeah, that's right. And I think right now you kind of have to look at all the chaos that's going on and forget pin the tail on the donkey. It's trying to pin the tail on a bucking bronco right now in the market. And I think what you have to do is start to look at characteristics for some of these companies that you want to see in the marketplace. And one of these is recession resilient. Another is tariff insulated. And I think coming up on this quarter, you have to have these companies that have strong free cash flow profiles and they aren't going to miss on the quarter. So what kind of industries check all these boxes? It looks like to me software is a pretty strong candidate for this. And if you think about software, it has highly recurring revenue, strong gross margins, and it's really benefiting off one of the major tailwinds that we're seeing right now, where the value being accrued in AI is moving from the infrastructure layer onto the application layer. And that's where software, I think, is going to particularly excel. Now, we have seen some of these names trade down significantly, and we have had some severe multiple contraction. But I think there's opportunities here where you can get in at very fair valuations, and software as an industry typically rebounds much more sharply when the market does turn, so it's good to get there ahead of the tape.
That's interesting. So the AI excitement last year was chip firms and electricity generators, but you think we've moved on from that. It's now to companies that sell software that will exploit AI.
That's right. And I think if you think about the corollary of the last build out in terms of the cloud cycle, what we had was a lot of the semiconductors really take off in terms of building out the groundwork that had to be done for all these systems to exist. Then we had sort of the services layer come to light. And then the application layer is finally where a lot of the value accrued into the system. And I think we are still going to get significant build out on the data center side. But we have had a little bit of jitters. Microsoft's pulling back a little bit, although Meta and Google are stepping in for that CapEx development. I do think we're going to see more of the value start to accrue to the software layer. And if you look at some of these applications, OpenAI is on an absolute tear right now. If you look at just how many users they're having, I think it's about 400 million weekly active users now, and they're starting to monetize at a pretty attractive pace. And just yesterday or the day before, they released 2 new models, which have even further capabilities. And we're getting closer and closer to this concept of artificial general intelligence that people love to talk about. But either way, I think we're going to get a lot more adoption and a lot more sort of rollout in actual use cases within enterprise workflows over the next year or so. And this is going to really come to light in these software applications.
And Microsoft is a stock you think is a good way to play this trend?
That's right. I think if you think about what AI is essentially doing, it's essentially a productivity enhancer. And who's the king of productivity enhancing software? Microsoft, right? So they're turbocharging a lot of their existing suite and really pushing a lot of this forward. They've also got an incredible partnership with OpenAI, and now they look to be peeling back a little bit on the CapEx, which shows they're having some discipline around this. So they're starting to worry about these unit economics. They're not lighting a mountain of cash on fire because they owe a public duty to the shareholders, and they were a little bit more insulated in this downturn, but I think they have a lot more attractive growth avenues over the short term here.
Netflix is attracting a lot of fans.
That's right.
Because TV shows, we don't have tariffs on those yet.
Yeah, that's right. And I think just like people kind of hid at home over COVID, a lot of investors right now are hiding in Netflix. And if you think about just what they're doing right now and where they are in the pecking order when it comes to the consumer's budget, people are not going to cut their Netflix subscriptions. They're not going to cut their Spotify subscriptions because what these are essentially digital consumer goods that are very essential to their entertainment. And if you looked at over previous recessions, Netflix usage actually went up over recessionary periods as people tried to really entertain themselves in a much more cost effective way. And now what we have with Netflix is really they have no exposure to China. They have no massive tariffs on the back of them.
Are they not active in China? I don't even know. Netflix.
No, they're not.
Oh, okay.
So what we're seeing here is this operating income story that's really starting to build out. And what we're getting is they're going to shift away from the focus on the subscriber base, which is very much user generated. And now they're starting to look at a lot more sort of profitability metrics. So I think this quarter, great setup. Also a great spot for investors to really weather this storm. And I think they're about up 9% year to date, despite this tape.
In similar vein, Spotify, the king of music streaming.
Yeah, that's right. So this is a pure play on content over cost. Software delivery platform, zero supply chain sensitivity. And what they're really doing is entering this margin expansion cycle post this podcast rationalization. So they started this podcast business. They've started to really optimize in terms of what they're paying for the content cost versus how they can monetize. And they actually had one of their first price increases recently and saw very, very little churn. So what we're seeing here is the unit economics really starting to inflect at Spotify. People have very much caught on to this, and we're seeing some strong margin profile here. And again, it's one of those names where it's the last for consumers to cut, so durable in these economic storms.
Right. Netflix, as you say, is up about 8%. Yeah, I enjoy podcasts, but my beef is I wish they'd just get on with it. I don't care what you talked about last week or how you had a great visit to Minneapolis. I just get onto the content.
That's right. And I think the content slate, just as they've started to optimize it, is going to be really attractive. And just to put a kind of sci-fi idea a little bit out there, is that I think the way that some of this AI content is moving and the way that some of these video generation platforms are going, you're going to be able to sit at home and say, okay, I want to watch Brad Pitt in a thriller. Here's the basic plot. Give me a little bit of surprise twists, but here's what I want in general. And you're going to be able to completely customize your in-home experience through one of these platforms. So I think that's an incredibly pie-in-the-sky kind of idea, but something that you could really help in terms of content. Now, also...
It'll create a movie
that you want, whatever you want to watch.
With Brad Pitt. It'll just have a fake Brad Pitt in a movie of this plot?
Well, now there are definitely going to be some IP concerns and some likeness that you're going to have to compensate some of these actors for. But the sort of general concept of that really is just that the cost of production is really going to come down as you have a lot of these kind of VFX work is going to be really optimized from a lot of these AI applications. And you're starting to see now, even we saw some companies in terms of the models that they're using from online retail and the e-commerce space, what they're doing is they're paying some of these models for the license of their likeness, and then they're using those images and that AI model to create different settings and different advertising copies in that space. So this is all a play on lower production costs, which is very margin accretive to players in the content space like Netflix.
That's interesting. Yeah, we've seen this ridiculous inflation in production costs. I'm not sure if you saw some of the episodes on Severance, the Apple show, costing $20 million US.
Yeah, that's right. And so you're starting to kind of have what we had was this very big war for the premium content overall. But I think if you think about, again, just that long-term play of making it much more scalable, making it much more accessible. And even if you think about kind of the international reach in Netflix and different kind of geographies, you can optimize to that, whether it's moving the mouth differently to different languages or a lot of different other sides of it. So really, again, just optimizing that sort of content cost and bringing those margins in line.
Yeah, we're just this thing about having anchors apparently speaking different languages and cheating them out. I've seen some incredible stuff like that. Thank you very much, Nick.
Thanks for having me.
Our guest there was Nick Mersch. He's portfolio manager at Purpose Investments.